Okay, so welcome. What's really exciting about right now is I know like some of the people on this call or some of the people that are going to be watching is that like you're a recent mortgage holder, whether it happened last week, last year, or a few years ago, and that's a lot to be proud about. But what's funny is that people put a lot of importance around getting that awesome rate, which is important. That's how you save money, right? But what you're really seeking out is you want to save money short and long term, and you want to make residual income. Everyone here has an investor mentality. At the end of the day, time is the ultimate currency, right? And we want to open up more time to spend with our families, things we love, and important parts of our business. And we want things to, work for us, right? So that's what leveling up really is about. And I want to, I guess, congratulate you for the live viewers or the post live viewers that you having the right mindset is really the first step. And what you'll learn is this stuff isn't really complicated, honestly, at all. Maybe at first it's a bit foreign, but it's quite simple to understand, especially if the right advisor. And like this can make a significant difference in the way you make residual income. And yeah, I mean, we have a great guest speaker today, Brent Davis. He'll be the highlight. And I'm going to start off with a couple interesting kind of fresh post-mortgage management topics, and we'll send it over right to Brent shortly after that. Today shouldn't be too long at all. Might be about a half an hour or less, and then we'll have questions, of course, throughout the chat today. Feel free to ask questions, interject, hand raise, even unmute yourself because we do have a pretty intimate crowd, right? So feel free. And with that, let's get into it. And there will be actually an interesting prize giveaway at the end, so pay extra close attention. All right. So a bit of the agenda, as you guys can probably read. We'll talk about, at the time of this recording, there's quite an interesting trajectory in the rates finally going up on the fixed side especially. There's, murmurings about variable and when that's going to go up. We're going to talk about the thing that I'm most passionate about. And I tell a lot of you this while you're about to get your mortgage is wait till you get to the after mortgage, the mortgage management, paying things off faster, choosing weekly over monthly, and shaving 3 to 5 years off your mortgage lifespan, or this thing called the Smith maneuver, which will be the meat of what I speak about today, is just dipping your feet in the pond, and then it's off the Brent. So, good old rate forecast. So this is a forecast on fixed. And what's funny is that people who got a mortgage within about even 3 months ago, you're looking at if you got a fixed rate, it's probably around 1.59, at least with the lenders that I was hooking you up with, right? So what's crazy now is that those same lenders, they are closer to 2%. And the actual math behind that is that for people who procrastinated and wanted to like wait out the market and see where things were going to go, the 0.5 difference on, let's say, a $500,000 mortgage, that's the same as you paying $150 more per month, right? That 0.5 is that's kind of the jump, which is quite a bit, right? So you get rewarded for being brave and being bold and making things happen. And yeah, as you can see, the rate forecast on the fixed side steadily going up. Variable is meant to stay low for a while. And again, here's sort of and why have the fixed rates gone up? It's the bond yield. They're correlated, right? So the bond yield is, of course, bonds that people can buy. That's been going up. Why? Because the economy is starting to recover, right? People starting to look more into stocks, and then they're ditching the bonds, and then the bond yield goes up. It's more of a complicated thing, but basically bond yields are going up, fixed rates go up, right? Now with variable, I get a lot of questions, even some of the questions from, the chat before this happened. You had your survey. Should I switch to fixed at some point? Well, depends, right? As of now, economists say that variable is going to stay where it is until 2023. Remember, you can switch to a fixed at any point on a variable side. You cannot do the opposite, and you have the peace of mind to know that if you want to sell or switch your mortgage, the mortgage penalty is limited versus on a fixed, we're looking at anywhere from 20, 30, 50,000. And some people who are going to be on the call today actually recently had that happen. So it's something that we all learn from, and we want to, of course, shield ourselves from those risks. And yeah, again, we are at a lower bond, so a lower bound rather. I don't see variable going down anymore, but it's definitely gonna stay where it is for a little while. So we'll see. But those are things for you to keep in mind, just on the should I hold my rate or not, where are things going. A little bit of like an anecdote or story, or just like a mindset shift, is that a lot of people do not invest. And I generally ask why, even to myself. Like, it took me probably too long to start investing. And I mean, better question is, do you know someone who's wealthy who does not invest? Like really think about that. Like, no, like people invest, right? So why don't we do it? Well, number one, you just did. If you have a mortgage, like you invested, right? For the purpose of course, your livelihood, for the purpose of future appreciation and perhaps having an exit, right? You are an investor. You got collateral. You just did that, right? Now, I think the issue is that I think number one is you've gotten your mortgage, but a lot of people now think they're going to invest in, let's say, mutual funds, ETFs, RSPs, something that Brent will talk about shortly, is people wait till they pay their mortgage off and then they want to invest. A lot of the cases, which I think is totally backwards. But the issue, of course, is that if you look at all your money, and after you pay your mortgage and your taxes and you have inflation and you have life expenses and you've got this COVID pandemic, there's not much left. So there actually isn't a whole lot of new money to invest. You gotta be very careful with that. So how can you somehow invest but not have to spend a whole lot more new money? And that's something that we're gonna talk about with the Smith maneuver in the next slide. Mutual funds and ETFs, by the way, I mean, these are rates of growth you can look at, right? 6 to 10%, and sometimes over 20%, but those have more fluctuations, right? So talk to your local advisor. But there are a lot of great investment vehicles that aren't in real estate that I know were part of the questions, like which one should I invest to? How do I balance both out? So quick little question. Who here knows who this is? I want to get some audience participation. It's going to be, who's it going to be? Carrie? You guys have probably seen his boat around the Cole Harbor area. So this is Jim Pattison. He's one of I think, like, I feel like the old school billionaire of Vancouver. Obviously got wealthy in many ways, but one thing just around mindset of taking on debt. This man started with debt and probably still has a ton of debt, because for him, debt is good. He likes to borrow other people's money and invest it. How do you think he got his car dealership? He financed it the same way you finance your mortgage, right? None of it really came out from his pocket. And that's really the mindset of the wealthy. And that's the way I think you can think about it with your current mortgage, right? And if you pay extra close attention in kind of the coming slides here on what I've introduced with the Smith maneuver, I'm going to give away a book at the end, which is honestly simple read, amazing insights. So from the Smith maneuver, no joke, there are like numerical examples in this book. You can be $400,000 to $900,000 better off in the 25-year mortgage lifespan that you may or may not have. Okay, it's insane. Those numbers are for later, but just like hold on to that thought and that potential. And basically, it's borrowing to invest, so no new cash is needed. And the main benefits are you can reduce your tax bill every year, because that is something that, of course, greatly affects most of us every year, or not all of us. You're going to monetize on compound growth, right? So money duplicating itself on top of each other. And you can actually eliminate your mortgage by 10 to 15 years, maybe even more, depending on how it goes. So those are all massive things that I know we want to do. And let me just show you, like, really quickly the high level of how the Smith maneuver works. And after that, you can start to extrapolate. So this might seem intimidating. Don't worry. Let me break it down to you. So the rule right now, by the way, and before I even talk about the rule, when you borrow money from like a line of credit or for a car loan, right, or even for your own mortgage to live in, you are borrowing to consume. The CRA defines borrowing to consume as, well, go at it. You're not getting any tax benefits from that. We don't really want to incentivize too much of that, right? Now, the Smith maneuver it's like this dude called, I believe it was, I think Fraser Smith. And of course, he's got a son who's like really, he's awesome. He's kind of pioneering what his dad created. But they kind of found not even a loophole, but they found something in like the tax code that you can borrow to invest and get a tax refund, which is kind of interesting. But through a certain investment vehicle, and this is going to be a line of credit, right? So here's how it works. So quick refresher: when you pay a mortgage, let's say $2,200. Part of it goes to interest, part of it goes to principal, right? And over time, less interest, more principal. Here's an example, right? $2,200. Let's say it's it's a $625,000 home. You got 20% down, 125. And here's a key thing. Remember, you cannot have a home equity line of credit. That is a line of credit secured against your home, where you can pull out funds in return for equity in your home until you own at least 20%. So if you had like a 5 or 10% down payment, this won't apply yet, but when it does, you want to be lined up and ready to look at implementing this. So here's an example where, like, let's say you own 20% of your home, and then when you pay $2,200, $940 goes to principal. So now you own 20.01% of your home, or zero whatever, with the $940. So the way it works with a readvanceable line of credit, which usually you're going to find with TD, Scotia Step, Manulife One, even MCAP is a line of credit. You here now opened up $940 of line of credit as you put down $940. The next month, now your line of credit doubles, right? So dollar for dollar that comes in, dollar that you're allowed to pull out for your line of credit to do whatever you want with it. But here's where we want you to look at investing it. And the way it works is, as I said, dollar for dollar, it opens up, and you get a full tax refund on the interest that you accumulate by taking out the 940 and then the 1880, et cetera, right? You get usually a 3% interest charge on that. Now, at the end of the year, the tax man's like, oh, wow, like we taxed you too much. You were actually using this money to invest in ETFs, mutual funds, even REITs, right? Real estate investment funds, whatever it is that you want. And there's a way to track this, and it's a bit more complicated, but basically this is the fundamental thing. And like, it just says quick math right here. After year one, you do this, and the 940 every month, right? You reinvest that off of 7% growth in, let's say, a basic mutual fund. You can get about $670. And then the actual tax refund is about just under $350. So total, call it $1,000. And that's money like that you get from, remember, no new money came out of your pocket. This is literally pay off the mortgage and you borrow to invest. And again, full tax write-offs. And now you're investing instead of waiting 25 years. And again, remember that number of 400 to 900,000? Yeah, that's the opportunity cost. So this is the concept I want to just plant with you. It goes against all the logic of how we grew up and the things that people told us, were good or bad to do. And I remember, all the debit commercials that say debit, 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 don't take on credit. If you're smart about it, it's the best thing you'll do. It's the best thing you'll do. So I want to, and again, this stuff, as you can tell, gets me really excited, and things that, again, talk to the right professional about it, but think about this. Debt is not bad. And now with a mortgage, you have an amazing asset to level up and scale. So with that, those are my quick 2 cents. Brent, take it away. Really excited to dive in. So people have got a mortgage, Brent. Now what?
Exactly. And so, before I get into this, I was really grateful when Paul asked me to speak on this subject specifically. And the reason for that is, being located in Vancouver, the majority of my clients are buying homes. And I am generally in the process of, working with them to plan to be able to afford that down payment, or they get introduced to me once they've purchased a mortgage to, focus more on the protection side of things, but also about building back up their savings after the fact.
Mm-hmm.
And the one thing I realized most of the times is that the majority of people I work with, the way that they view a mortgage or borrowing money isn't necessarily in line with how they can maximize their wealth. And so even today, I was meeting with a client, we were doing a review, and we were talking about some net worth projections so that, he just bought a home recently, and we were looking at, based on certain assumptions, what does his net worth look like in 2 years, 5 years, 10 years? And so I asked him the question, what do you believe your net worth to be today? And his response to me was about a negative minus $1 million. And it struck me, but I wasn't surprised because I've seen this a number of times. Now, just going to throw it out there. Does anyone potentially know why that person thought that he was worth a negative $1 million?
I don't know. Is it because they had a big mortgage?
Exactly. Great guess. And so, once I sat down with him and explained to him that's not how you necessarily want to look at it. In fact, it's not even necessarily, you definitely don't want to look at it that way.
Mm.
We started to change the perspective of how to view life after having just, bought a home. So before I get into this, I just want to say that the whole intention of this is to be purely educational. I'm going to keep this very high level. Please feel free to ask any questions throughout this time. But really looking forward to getting into this.
Let's do it. Awesome. I love it. Great primer.
Perfect. So where do we start when we're talking about building a financial plan? Typically speaking, most people in this industry, but most individuals themselves, tend to focus on accumulating wealth. So in order to make that down payment, you had to save money. You didn't just walk up one day and go talk to Paul and just be able to make it happen. There had to be some sort of planning involved there. On the other end of things, we don't talk about this enough, but protecting your wealth is just as important as building it. So when it comes to wealth building, there's two segments we think of: liquidity and retirement planning. Liquidity planning is just planning for something that you might need money for in the shorter or medium term, such as a down payment, for example. Whereas retirement planning is obviously longer term focused. Whereas with protection, living benefits asks the question, what if something happened to your health throughout your life and you actually lived? What would you want to have happen to your life and your finances as a result? And life insurance asks the simple question of, if you were to pass away yesterday, would anyone be financially affected? Next slide. So before I get into the specifics of this, just a little bit about myself, my process, and my firm. So I'm with ZLC Financial. We are an independent firm, meaning that we're not tied to any investment company or bank or insurance company. We act as brokers, and when we find solutions that fit our clients' needs. The biggest part about that is making sure that one plan or any plan that I do with any client is specifically tailored to that person's needs, whether it's focusing on wealth management or specifically insurance planning or tax planning or retirement planning, or as the list goes on, as you can see, that's the most important thing. And so the reason I bring this up is, it doesn't matter if you're doing this with an advisor like myself, or if you're doing this on your own, tailoring it to your needs and also understanding how to best set yourself up for success is the most important thing. And that's what I always want to make sure that I'm focusing on when I'm working with someone. So on that note, next slide. How do you start building up your savings? So as I mentioned, most important question to ask is, what are you working towards? Now, I just want to throw something out there. You don't necessarily have to have a plan in place that's going to be absolutely rock solid. In fact, most people I work with, they've been thinking about buying a home, especially if this is their first purchase, first property purchase. They've likely been thinking about buying property since they were a young kid. And to finally get up to the point where you finally, you're working, you finally have enough money, and now all of a sudden you're really getting into that process of you're looking at homes and applying for a mortgage. And then bam, you have the place that you've been thinking about forever, but what's next? Most people don't know, and that's completely all right. But at least, starting to think about what you might want is really important, because how you invest that money or how you go about trying to save that money or build up that savings is really the only place to start. So whether it's creating a flexible plan or having some specific target in mind, distinguishing that is very important, but you can do the same by being flexible. And so some of the things that we like to think about are, at least some of the things I see clients focusing on after a mortgage are an investment property. The Smith maneuver being like exactly what Paul was talking about. That same thing applies to buying a home that's not your primary residence as well. A second home I see a lot as well. But what about a car or starting your own business or just day-to-day expenses or day-to-day lifestyle related things like taking vacations every year? It could be a multiple number of things, which I see all the time. Maybe you have, a rainy day fund, so that if you want to go on a vacation on a whim's notice, you can. But maybe you're also trying to be more long-term focused. But the most important question I always ask everyone that I work with is, if a financial emergency or opportunity came up today, how would you be able to deal with it? That's the most important part. And so typically speaking, when we're talking about an emergency fund, we're looking at about 3 to 6 months income. Now, that's a very old school mentality and way to look at it. I personally don't view it the same way. Um, with the access to credit that we now have, which is completely unprecedented, if you looked at it about 20 years ago, um, even having access to potential credit, like just ask if you have a plan and it involves credit, but also some component of savings. I'm completely in favor of that. And the reason for that is the cost of living in Canada is just getting more and more expensive by the day. And just to hold money in a savings account that's going to make less interest than what inflation is going to be is not in your best interest. So having some sort of cash on hand, but also potentially whether it's a home equity line of credit or an unsecured line of credit, or some conservative investments in an investment account. There's a way to go about that, and that's where you'd want to tailor it based on how you view uh, the risk associated with potentially not having cash on hand. So now that I've mentioned all of this, um, you know, buying a home is extremely valuable in a large part for two reasons. One is because you get to leverage. So, if you put $200,000 down for $1 million place, your investment's $1 million at the end of the day. It doesn't matter if you put $500,000 down or $200,000 down. If that asset grows by 10%, it's on the $1 million. It's not on the 200,000 or 500,000. But it's because mortgages exist that we're able to take a portion of that amount and actually participate in the full growth. Now, of course, there will be differences in terms of how much you pay for, one size of a mortgage versus another, or one rate versus another. But the second most important thing to this is that a primary residence is tax sheltered. So what if we applied that same logic in my world when it comes to financial planning? So when it comes to building out a plan, especially on the accumulation side of things, focusing on any tax shelters we can is the most important part. So let's start with the TFSA. Who here has a really good idea as to what a TFSA really is? So what I'll say about a TFSA is that it is called a tax-free savings account, or tax-free savings it is account, sorry. The amount of times in my career that I've seen people just holding cash, like a traditional savings account, is absolutely mind-boggling. It should be called a tax-free investment account. But for some reason, they end up calling it a savings account, and that's tricked a lot of people into thinking that it's the same thing as having a checking and savings account, essentially. This is the most powerful tool that we have available to us as Canadians when it comes to investing that's not in a primary residence. It's essentially the primary residence of investing, is the way I would equate it. The way it works is after you've been paid in what I would call after-tax dollars, any money that you put into a TFSA, there's no tax deductibility. Essentially, you're keeping after-tax dollars and maintaining after-tax dollars. Any growth that you receive within a TFSA is tax sheltered. And as a result, any money that you withdraw from your TFSA is after tax as well. So there's no taxable implications as a result. Now, there's a really interesting way in terms of how we've ended up to this lifetime maximum of 75,500. I'm not going to get into that too much, but just know that if you want to know what your contribution limits are, you can check on your online CRA account, as they generally will have an updated amount as long as you paid your taxes or filed your taxes for the previous year. But say you've maxed out your TFSA at 75,000, for example, and by the end of the year, you had a really good year, it grows to $100,000, and it's December 15th, and maybe you're thinking about buying a second home or another property, and you decide, let's take out that $100,000 from your TFSA. Well, the good news about this type of plan is that in 2022, not only can you put in your new 2022 contribution, which I expect will probably be $6,000 like it was this year, but you can put back whatever you've taken out the previous year. So you can actually put it back $106,000 in 2022. Doesn't mean you have to do it all in 1 year, but it just provides you that flexibility so that if you want to build up this account, you don't lose a contribution room just by withdrawing it in case you need to use it in the short or medium term. Because of this, it's amazing for short, medium, and long term. And in fact, I probably suspect that in the next 10, 20, 30 years, we'll see this being talked about as the most important part of a retirement plan. The reason it isn't being talked like this at the moment is it's only been around for about 12 years or 13 years. So we haven't really seen the implications of tax sheltered growth in a flexible plan like this over a lifetime or half a lifetime. So I just want to show an example as to why starting early and in a tax shelter is super important. So let's take two people. Person A contributes $2,000 a year for 8 years. Now, for this example, let's just assume that there's a 10% rate of growth annually, and it's growing for 45 years. At the end of the 45 years, for the person that only put in $16,000, they would have $855,504 left over. Now, in the second example, if you were to start investing or contributing $2,000 a year in year 8, but you did it for 38 years with the same type of growth, as you can see, only an estimated just sub of $801,000, but there's approximately 5 times more that was invested than the first person. So very important, because this just shows the value of compounded growth over a long period of time.
Wow.
I remember when I first looked at this, I thought there's no way this could be true. Like the idea of someone putting in 72 grand versus 16 grand just didn't seem to make sense. But it's really the long-term focus and the fact that you're not reducing the amount by having to pay taxes on this every year. So the question then is, what if this was taxable? What would that look like? Can you move over to the next slide?
Totally.
Now, there's 3 different types of ways that you can get taxed in Canada. The first is a capital gain. So let's just say that you bought a stock for $1,000, and you sold that stock at a 100% gain for $2,000. The way that works is that $1,000 of gain is considered the capital gain. Of that $1,000, 50% of that, so $500, goes in your pocket tax-free, no questions asked. The other $500 gets added onto your taxable income for that given year. So how much tax you pay on that is completely dependent on what marginal tax rate you're at. Interest is essentially you receiving money for borrowing out your money or lending out your money to someone else. So this can be in the form of bonds. A mortgage is a perfect example of that as well. GIC, savings accounts. Any interest you receive from an investment is 100% added to your taxable income. Now, a dividend is essentially a thank you from a company for participating in the ownership of that company. Now, because that money has already been taxed corporately, the CRA doesn't want to double tax that money unnecessarily. As a result, as an investor, you typically get a special rate. For argument's sake, let's say that on average, it's about 2/3. So in that same example, like capital gains, 33% of that goes back into your pocket, no questions asked. The remainder gets added onto your taxable income for that year. So reverting this all back to that last example, what if it was taxed? Now, person A has just over $200,000 less if it is. Person B, on the other hand, not as much of a loss, but still substantial, relatively speaking. So, and this is just an example. So this actually kind of mimics more so an RRSP, which I'll get into in a second. But if this was in a taxable environment throughout its lifetime, those numbers actually wouldn't be right. It would most likely be less. And the reason for that is there's potential that you'd be taxed every single year, depending on what the value was at the end of the year. So the reason I bring this up is that I'm really just trying to highlight the importance of focusing on a tax shelter and starting early. It makes a huge difference. And where we can get into some of the minutia of this is, if you start to look at using like the Smith maneuver, for example, if you've maximized your tax shelters as well, there's an amazing opportunity to even elevate those numbers even further, assuming that there's still good market growth at that time.
Totally. Love it.
So RRSPs, I think they're great in some cases, but I don't think they're the end all be all like we typically talked about them forever. The reason for this is, unlike a TFSA, what you're doing is you're taking your after-tax dollars and you're converting them into pre-tax dollars, which is why at the end of the year, when you go to file your taxes, say you put in $10,000 and your marginal tax rate's at 30%. You would then receive a $3,000 tax break as a result of converting that after-tax dollars into pre-tax dollars. Now, similar to a TFSA, an RRSP does grow tax sheltered. However, because you are converting it to pre-tax dollars, when you go to take it out in retirement, let's say, you're now converting that back into after-tax dollars. So whatever you're taking out is getting taxed. Now, say you put some money in an RSP and you never invested it, which I'm not recommending you do. But for the sake of this example, the whole point of it is that while you're working and generating that income through your working years, you're likely going to be at a higher tax bracket because of the amount of income you're making. When you get to retirement, you likely won't be needing that same type of income that you did in previous years. So just based on that alone, you should be netting some just based on the difference in tax rates that you would have been paying in your working years versus retirement. But more importantly, because it is taxable in that sense, I do think that when it comes to retirement planning, focusing on RRSP, especially for young people, is really more focused for a home buyer's plan. After the fact, it's really more about paying it back and really starting to build up some sort of savings, even if it's a small amount. Because if we think back to that person A versus person B example, even starting off with a small amount really can make a big difference long term.
Yeah. And side note, so you want to explain what a home buyer's plan is really quick?
Home buyer's plan is when you can save up to $35,000 in an RRSP and borrow that towards the down payment of your first time home purchase, which would then be paid back over a 15-year period.
So you take it out, don't get taxed on it, and then when you pay it back over a 15-year period, then that's when the tax comes later on, right? Because it's pre-tax and then it's moved. Is that the way it works?
Sorry, can you repeat that again?
So I have 35,000 in my RSPs. I put it for a down payment. I'm guessing the benefit of that is what? The
government allows you to borrow that money as opposed to actually withdraw it. So there's no taxable implications as a result of you borrowing that money. So the best way to think about this is, say you're at a 30% taxable rate.
Right.
So if you put in $35,000, I mean, you should be doing it over a few years because you have to have it in there for at least 3 months before you're able to actually use it.
Key point.
But if you do that and you're at 30%, then if you can save $35,000 into an RRSP, then times that by 30%. So what would that be? $10,500 extra to go towards a home. So instead of 35,000, now you have 45,500. And if you have a spouse you're doing this with, times 2. And the larger the tax rate, the better return you receive as a result of that spread. So, so it's because you're borrowing it, you have to pay that back over a 15-year period. Right. If you don't pay it back in that any given year, all that happens is that amount gets added onto your taxable income for that year. So it's not the end of the world, but it is a good incentivization to try to get younger people to save money in this vehicle and then incentivize to use it in the shorter term.
Yeah, and the key caveat obviously is like you're saying, you're putting this over time, you're saving about 10K. Those 10K you save should be stored somewhere, right? Because if you spend those $10,000, you don't get taxed on, it defeats the purpose, right? So
absolutely
highlight that, obviously. Okay, yeah, that makes sense. Very, very descriptive. Did you want to skip over this or anything you wanted to tie up over there?
Nope, this is a perfect segue.
Okay.
So, as I mentioned previously, we tend to focus mostly on the accumulation side of things, and I understand why. It's a sexier thing to talk about. It's a more exciting thing to talk about. But the reality is, now that you have a home and you have probably the largest debt you'll ever have, unless you upgrade your mortgage further down the road, is what are some life-altering events that can affect not only your personal life, but your finances as well. So when it comes to insurance, and I'm going to keep this very high level, because, I could spend an hour itself, if not more, talking about this alone. But as I mentioned, the two cornerstones of protection are living benefits. So if something were to happen to your health and you continue to live, what would you want to have happen in life insurance? So when it comes to life insurance, I'm just going to focus on term for the sake of this conversation. Term is for terminating need. Mortgage is a perfect example. So you buy a home, you don't expect to have a mortgage for the rest of your life. So if, say you're married and you have some kids and you bought a home and majority of your savings have gone in here now, if one of you were to pass away, the question is, would your family still be able to afford to live in this home? So the thing we typically look to focus on is just having enough money, or at least a pool of money there, so that you could pay off that mortgage if you chose to. Now, I'm not saying that's always a good decision from a financial planning perspective, but that's how we focus, or that's what we focus on when it comes to mortgages. Now, quickly, permanent is a essentially term with an investment option or investment aspect to it, that can grow tax sheltered. If anyone's interested in learning more about that, I'm happy to talk about that offline.
Yeah.
But term is really more so focused for mortgages.
Cool.
Living benefits, there's two major distinctions. Disability insurance provides a income in the event you're unable to work for an extended period of time, whereas critical illness provides a tax-free lump sum in the event you become critically ill and survive for 30 days.
Oh,
So
okay.
all of these things are just asking the questions of, the what ifs of life. What if this happened? Would it affect your ability to continue on this mortgage and to build this asset that you spent maybe your whole life thinking about and trying to build towards? So now if you go to the next slide, when it comes to life insurance specifically, the general questions we always ask is, do you have a pool of capital that would replace your income? So it's not just necessarily protecting your mortgage. It might be, if you were to lose someone's income, would that also affect your life? And so what we typically can do is we'll take a amount of money that could be invested, say for a 5% rate of return, to help generate some sort of income to replace that lost income. Debts is the most important thing as well. You never want to leave someone with a debt that they can't deal with financially. So this can be dealt with using life insurance as well. And then next. I touched on this a little bit. We don't talk about it too much these days, but life insurance can also be used for building an education fund for your kids. If something were to happen to you and you losing the ability to provide into or contribute into an RESP. Now, when it comes to critical illness, I actually think that this is arguably the most important type of insurance people should be getting when they have a mortgage in their younger years. As anyone I'm sure can relate, as generally younger people, you tend to feel a lot more invincible. But as you get older, you start to experience real life, and you usually start to see people get sick, or just things start to happen that you realize that involve just real life. And so, as I mentioned, critical illness is a tax-free lump sum that you receive after 30 days of surviving. It was a product that was actually created by a South African doctor almost about 20 years ago. And the reason was he was starting to see that patients would come in with terminal illnesses, but weren't dying at the same rate that they used to. Now, as I'm sure you can all imagine, this has just increased exponentially as technology's improved. And I'm very curious to see where it goes, in the years to come. But the aspect of this that people don't realize is, what if you did get sick? How would that affect your finances? So let's take an example here. A 55-year-old has been saving $3,000 a year since 25 years old, with the intention of retiring at 65. And all of a sudden is diagnosed with cancer, isn't able to work anymore, needs to focus on getting better, has expenses to pay. Now, in order to do so, there's not many options. You can either borrow money. If you have the cash, you can hopefully use that, or you can borrow or take money from your investments. In this case, unfortunately, this person had to take $100,000 from their RRSP over a year in order to get better. But as you can see, the trajectory of their retirement savings plan has now significantly been reduced, and their quality of life in retirement might never be the same as what it might have been otherwise. So critical illness can be bought like term life insurance can be, or it can be bought on a whole life basis. Um, but typically when we're looking at protecting yourself, you want to keep it as pure coverage and cheap as possible, because it is really just about dealing with the what if of life. Um, Now, the other type of living benefit that exists, as I mentioned, is disability income. Um, Now, I mean, I kind of just gave it away, unfortunately. Can you move over to the next slide? But when I ask a lot of people what their most valuable asset is, most people don't actually realize it's actually your ability to earn an income throughout your lifetime.
Mm.
Sure, your home might be your most valuable asset monetarily today, but if you don't have a job, I wonder how you'd pay for that mortgage and hence that home. So uh, now the thing about disability insurance is that um, getting an independent plan through an advisor like myself is quite difficult. About 60% of the time, in my experience, most applications will come back either declined or with some sort of exclusion based on your previous medical history. So I've seen examples where, if maybe you hurt your back, on the playground when you were in elementary school, nothing's really been an issue of it since, but it's been, maybe you've had some pain here and there. Well, the insurance company might say, hey, we don't want to we'll protect everything but your back. As a result, MPP that comes directly through the lender typically is an amazing option in order to protect that. It's not the best, and there's definitely a lot of things I don't like about it, but because your most valuable asset is your ability to generate that income, I do think it is tremendously important to some degree, or at least having some sort of plan around the potential loss of income. It doesn't necessarily have to be through insurance, although insurance is definitely an answer to that question. Now, lastly, just some tips and tricks I like to tell all my clients is have a plan and stick with it. Make sure you pay yourself first. So treat investing or saving money like a bill. You're never not going to pay your cell phone bill or your hopefully at least, or your mortgage bill. So if you have the same type of mentality with putting money into a TFSA or an RSP, I find that actually is probably the most important thing out of this. But set realistic goals. Make sure you diversify your investments. Don't put all your eggs in one basket. But if you have the home, which people typically do, now is the time to start building up that diversification. Don't be greedy. Protect your assets. Stay informed. And in being informed, that means always updating your plan. Life changes. It's very fluid, so make sure you're changing with it. Use credit wisely. I thought what Paul talked about at the beginning was great, because he is right. A lot of wealthy people make money by borrowing other people's money. Now, we're not saying go take your HELOC and buy a Tesla or something necessarily, but if you use it wisely, it can make a huge difference in building your finances. And as a result, take responsibility for your finances and don't give up. And that's all for me today.
There you go. Wow, Ripple, that was awesome, man. Some snaps. Perfect. Well, guys, we're all wrapped up, and we do have some exciting prizes. One's going to be in the follow-up tomorrow. And also, I have a bit of a trivia question now. But before that, just some snaps for Brent. That was amazing, man. Like, I feel like you know your stuff so well, and like I love the way you just describe it so clearly. I feel like whenever I've been in past, presentations with, investment advisors, I feel like I just kind of tune out. I'm like, oh, it feels like the same thing. But the way you're articulating it and the examples, it makes it really seem easy. And it does, for the large part, seem like very doable. It's just about people, caring enough to actually do it and not be like, oh, I got my mortgage. Okay, we're good for 25 years. So I think that's super important. Just out to the audience today, I guess if you have any questions, those will come in 30 seconds. But firstly, to win a book for the Smith Maneuver, who wants to take a stab at least two benefits of deploying the Smith Maneuver? So you can either unmute yourself or you can put in the chat, and I guess it's going to be whoever says it first, really, and says it correctly, is going to win the book. So who wants to take a stab at it? I'm going to make sure everyone is actually allowed to speak. There you go. Mohammed, nice to see you. Shane, thank you for joining us. I didn't see you guys at the beginning. We're all here now. Yeah, we got about 8 peeps. So who knows? And if you missed the part of the Smith maneuver, then I guess that's you'll have to learn from your peers. But who wants to guess? Even just one thing about the Smith maneuver that is beneficial.
If
You
you
can.
pay, oh,
Oh, we
No,
got two
go ahead.
people, Alex and Carrie. Oh man.
yeah,
Go ahead,
How about
Carrie.
this? Okay, why don't you both go, and I might be generous and give you guys each a book, depending on how you work as a team. So why don't we go ladies first? Carrie, give us at least one benefit. If you want to say more than one, I'd love to hear it. Alex.
one benefit with the home equity line of credit, if you do weekly payments, you can pay down. Yeah, you don't have to pay as much interest over time.
So yeah, and so that's actually something you can combine with the Smith maneuver. So yeah, first thing is I said I had a moment where I said if you pay weekly versus monthly, you're paying off your principal a lot faster, and therefore you can borrow more from your home equity line of credit to then invest and get a tax write-off on. So that was actually a combination of just a little mortgage hack. And yeah, the core benefit is you can borrow to invest and get a full tax refund and take advantage of compound growth, which totally debunks the idea of like, oh, I'm going to invest once I have extra money, which we never do based off of taxes, inflation, etc. So that's a great one. Alex, do you want to jump in and rip off of that? What's another one?
You just
stole it, huh?
pretty much took it, yeah. About how you can use it to as a tax write-off.
Yep. And then here's a question. Because of it being a tax write-off, what does that do in terms of building wealth or burning your mortgage faster?
It reduces your taxable income.
Yep. Yep. Right. You get taxed back. And then since you borrow from your home equity line of credit as dollar for dollar as you pay down your principal of your mortgage, you invest that from your line of credit, put into, let's say something in a TFSA or an RSP, let's say it's a mutual fund or a stock, right? As you make compound growth from that, you can let that keep compounding, and or you can pull money out of your investments to pay off more of your mortgage. So at some point you do the trade-off. It's like, I've made $100,000 extra dollars in the first, let's say 10, 15 years. Do I let that just keep snowballing, or do I use that to pay to have a huge prepayment privilege on my mortgage? What's the usual prepayment privilege? Up to 20%, right? So then it becomes a balance. If you've got more money to pay off your mortgage, or keep investing, or do a bit of both. So it's reduce your tax bill. You monetize on compound growth. You do not wait 25 years. You guys remember the example of person A and person B with what Brent was saying? That wasn't even really off like a specific Smith maneuver. That was just off people investing later and the opportunity cost, right? That's a huge one. So reduce tax bill, monetize compound growth, and limit your mortgage by 10 to 15 years. So you are borrowing and you're investing at the same time, just like what Jimmy Patterson does of all his dealerships, right? And that's where we're going to have the next billionaires in the room. Carrie and Alejandro, you guys are a sweet team. You're both getting a buck. Thank you for.
Woo!
There you go. Yeah, finance can be fun, right? Awesome. We'll open up the floor for another few minutes. Any general questions for myself or, of course, Brent? We talked about a lot. Maybe I'll skip to the beginning of the agenda. And if there's any questions, maybe it'll spark. We talked about a lot. Hey, look at all the stuff we talked about. So here's the agenda. So yeah, I'll open it up. You can unmute yourself or type it in the chat. We'll go for a couple more minutes before, obviously, we hit 6 o'clock dinner time, right? Or patio time, depending on what your plans are. But yeah, any other questions? Carol, Mohammed, Fernando, Shane?
Can you hear me by any chance?
Yes. Hey, Mo.
Hello. So I have a home and I have 2 cabins that I invested on.
Yes, congrats.
I might be renting. But wondering, I like the Jim Patterson idea, of course, and I know that many of them borrow money to become even richer, correct? So how can I do so to buy more properties?
Well, it's a good question. I don't know, Brent, did you want to take a stab at that as far as how can he, duplicate his wealth? He's got an investment property, he's got rental, he's got equity, he's got the ability to invest in TFSA RSPs. Is there a way he can accelerate his savings to buy more properties based off some of the tax shelters you talked about or anything like that?
I honestly wouldn't be able to do this question justice by talking about it too general. Because it is based on your specific situation in terms of how much equity you might have up. I mean, like the Smith maneuver is really, or at least the idea of the Smith maneuver is how I would approach it personally, especially if your focus is on real estate. I have a number of clients who, the way they explain it to me is they don't necessarily know the stock market, but the way they make their money is what they know is the real estate market. So is anytime that they can take out more equity from their home or at least refinance their mortgage to use that to buy other homes, especially with the tax deduction that comes in the interest payments, is definitely the easiest way. There are other strategies. I see people borrowing money from their whole life insurance policies if there's enough money in there to buy additional homes. The TFSA would be a way to do so if you can get, depending on market timing, of course, and how your investments have done. But I would caution that, in an ideal world, if you have the ability to do so, that investing in a TFSA long-term is arguably just as beneficial, if not more. I mean, the reason why, compared to primary residence, is what I'm trying to say. The reason it wouldn't be is your lack of ability to leverage in a TFSA like you can for a primary residence. So it is like the primary residence of a investment plan personally, but other than that, though, I would say it's really more. I see a lot more people refinancing or taking money from their line or home equity line of credit to do so.
But the refinancing that we're talking about, it's more. It's a market price versus the government stated price, correct? So, for example, my current townhome that I have, as per the assessment, it's assessed by the government to be worth how much was that? I think Paul was 535, I believe,
Right.
or
Yep.
560 or something like that.
Yeah.
But the real price of selling this home, it's at this current moment is 645, correct?
Yeah.
So how can you monetize based on that? Because I believe banks do not accept based on the current market price, but rather accept based on assessment from the government.
Well, if you get an appraisal and it appraises the fair market value you just talked about, let's say 645, and they'll take the appraisal. The property assessment is just what's there, but they'll take the appraisal, right? Can't be the same appraisal you got for your mortgage, because the thing about appraisals, they're only for the mortgage lender. They're done very specifically. You can't reuse them. That's why we can't give copies, unfortunately, even though you pay for them. I know it's wild. But if you get an appraisal just for that, then remember, home equity line of credits, it goes off. You can go up to 80% debt of the appraised value. So that's probably going to open up 80% of the capital gain there. Call it $100,000. You got about $80,000 more that you can use from a line of credit to invest, get tax write-offs, or you can use that against rental properties. Remember, because if you borrow to invest, so you borrow your line of credit to invest in a rental property or do something to a rental property, that counts as investing, assuming it's purely meant for making money. So I think there's you're unlocking more equity to then actually do things with that money to borrow to invest.
So it's not based on primary residency, right? It's based also on the rental that I have, right?
Say it again. It's based off the.
It's not only based on the primary residence that you guys were talking about, but I could also borrow from my investment property as well, right?
Oh yeah, 100%. And that's probably where it makes the most sense, honestly. It's borrowing from an investment, because then like everything there is for sure going to be tax free, because it's an investment, and then you're leveraging that. So yeah, you can. Just make sure you do it wisely. But yeah, like any equity you have, like you should be doing something to convert that from non-deductible debt, because that's what it is, right? To deductible debt, which has to be done through a line of credit, right? That's where you can borrow to invest. If it's just paying off your mortgage, that goes to the lender. There's no tax benefits there.
So then the suggestion would be best then to change from a monthly payment to bi-weekly or weekly payment. That would be the wisest decision.
Well, again, assuming that you're okay with your bank getting the mortgage pulled every week or every 2 weeks, as long as there's cash flow there, which I'm sure there will be, right? Then it's fine. And then again, you're paying your mortgage off a little bit faster, and you've got more of the HELOC you can open up, because Remember, there's more, 52 payments in a year versus, let's say, 12 payments of 4 weeks. There's about a 4-week gain there. If you go weekly to monthly, you get about a month worth more of prepaying, which also means a month more of HELOC you can unlock, which we can talk about more offline. But generally speaking, yes, there's a way to, in combination, pay the mortgage off faster and borrow faster to then invest and take advantage of capital, of compound growth.
Cool. All right.
Cool.
Thanks.
Yeah, great question. We got deep there. To wrap up, any other clinging questions here before, of course, you all know how to reach me, of course, and I'll leave Brent's information here. Any kind of lingering questions on, all the things we talked about?
I have a quick one.
Oh,
Carrie can go first.
Sure.
Just going off of the HELOC, right? Like the tax write-off only works if you're investing into other investments, right? Like if you were to spend that money on, say, home improvements or like a car as an example, there is nothing to write off.
Correct. Unless the home improvements are on, I believe, don't quote me on this, I believe it's if they're on your investment property, and that's different because it's
Okay.
some gets to invest. You have to talk to, obviously, your Smith Maneuver advisor or a financial advisor, but the idea is if you're borrowing, it must be to invest into something. Anything that seems like you're consuming, borrowing to consume is a no-no.
Okay. Makes sense. Thank you.
Yeah, cool. Great question. I heard someone else also had a question there.
Yeah, it's me. It's Shane. Thanks for your time. Just a quick one. Let's say I have cash ready to invest in a non-registered account, and I also have cash ready to invest in, say, an RRSP. What's like the typical framework or considerations that you would decide before you pull the trigger on either account? And just want to know what those considerations would be in each of your perspectives.
I love it. Great question. That's totally a Brent question.
Yeah, it's a great question. So the way I would approach that is when it comes to RRSP contributions, I typically try to be as strategic as possible. So if is there an amount I could put in that's reasonable that would put me down into the next tax bracket so I can maximize that amount. Also just knowing what the bucket of money is for. So if you want to put this away for the longer term for retirement, let's say, RRSP is definitely the way to go. If you want it to be more liquid, potentially, I would tend to focus more on a non-registered account. So what I'll do is I typically don't do monthly or weekly contributions into an RRSP unless, I do a certain amount that I know is a minimum, let's say, that is comfortable, where we could then potentially, after the fact, between January and February, go ahead and make an additional contribution to be more strategic. So I typically like to have some ammo in the chamber for that type of situation. But it's really up to you depending on that situation for sure.
Okay, thank you.
Thanks, Brent. That's awesome. Cool. Well, looks like it's dinner time. Love the energy of the questions, everyone. Again, this is what defines you as an investor and as a homeowner. It's thinking like an investor, right? It's not thinking like the way most of our educational systems taught us around, debt is bad and, don't do this and do that. Be entrepreneurial about your mortgages, about your finances. And also remember, you have to be strategic and there are the what ifs, but the crazy thing is that the what ifs and the way to grow your wealth can actually all be part of the same bucket. And that's, again, a deeper conversation with Brent. But with that, Brent, this is awesome, man. And Brent worked really hard on this presentation, and we worked really hard on just making it as hopefully as simple as possible to provoke the right questions. Again, I'll send out the recording shortly to our VIPs. And guys, everyone, thank you so much for tuning in. Be well. Congrats on the recent mortgages, and let's keep leveling up this year.
Thanks.
Thanks, Paul.
Bye.
Thanks, everyone.
Thanks, guys.
Thanks,
Take
guys.
care. Ciao.